Today I'm going to talk about one of the biggest issues that I've seen when talking to real estate agents, one that a lot of real estate agents have at least experienced in their life, whether they're successful or not, and that is the problem of managing the cash flow from your commission check. So when talking to real estate agents, one of the biggest problems I've seen is that they potentially fall behind on their quarterly tax payments, or they're kind of scrambling for money when it comes to actually making those tax payments, or they realize that they haven't saved any money from those commission checks because they just spend it right when they get it. This is a problem that I believe is critical to solving when you're a real estate agent, and I think it'll lead you potentially to higher levels of success when you're in the industry. For those who don't know, my name is Aiden Boorstein. I'm a financial planner with RockCrest Financial in Somers Point, New Jersey, and we specialize working with real estate agents. So one of the things that we've helped solve for a lot of agents is the problem of managing that cash flow from your commission checks. So that's what we're going to talk about today, how to manage the cash flow from your commission checks from our standpoint. And there isn't a set in stone way. You could do this a bunch of different ways. You can kind of manipulate the process, but there are some rules that I think some real estate agents should be following if they want to have a better chance at properly managing the cash flow from those commission checks. So first of all, why is it important to actually kind of get this right? Well, it's because you make 1099 commission checks, and unlike a W-2 where taxes are taken out, state taxes are taken out, federal taxes are taken out, you're potentially saving towards a retirement plan, and it all comes out and you just get the remainder of that check. 1099s don't get that. So 1099s basically get the full amount, and they're in charge of dividing it up. I like to think of it as, a W-2 goes to the butcher shop and they get the filet mignon, versus a 1099 independent contractor, like a real estate agent, goes to the butcher shop and they get the whole slab and the butcher tells them to cut it up themselves. It's kind of unfair, but you kind of have to work with it, and being able to understand how the process works and how you can almost automate the process for yourself can set you up for success further down the road, and even in the meantime, where you might be able to save more money from those commission checks and have less stress when it comes to knowing how much you had to set aside for your taxes and not falling behind on your taxes. So the first thing that I'll talk about is having at least 3 different accounts. Now, this is just the way that I would do it. You can have more or less accounts depending on how organized you are, but from a financial planner standpoint, from my standpoint, I would just have 3 accounts to start with. The 3 accounts are going to be a cash flow account, a tax account, and a savings account. What would happen is the cash flow account is pretty much your bank account. It's where the checks get deposited. It's where you may pay some bills from. But then when you have that account and the check gets deposited, immediately what you should be thinking is to set aside some money to the tax account and set aside another amount of money to the savings account. So we'll talk about kind of how you can set that money aside, what percentages to use for those accounts to set money aside in. But for the most part, those 3 accounts are going to set you up for at least a basic strategy on managing that cash flow. For the account that you set aside your taxes in, I would recommend using a safe account, and preferably an account that has a yield on it. So like a money market account or like a high yield savings account where you can get a higher interest rate might be more beneficial to keep the taxes in, because at least they're not sitting and they're sitting still. They're at least potentially growing throughout the year. And for your savings account, this could be a retirement account. Preferably you can use something like a SEP IRA, a solo 401k, or even just traditional IRAs and Roth IRAs. So there are options to how you can invest and save for the future. There are taxable accounts that you can even use, but the goal in the end is to really have an account that you make sure that you set a certain amount aside from any income that you make into that account. So the goal of this savings account is just to push yourself to remember that every time you get a commission check, you set aside a certain amount of money into that savings account. For everybody, it could be a little bit different. You might want to set aside a flat percent. Let's say you chose 10%, for example. Every time you get a commission check, you would take 10% of that commission check and just push it straight over to the savings account. And you could do a bunch of different accounts. You could do taxable accounts, retirement accounts, whatever you choose. Just make sure that that process in your brain gets automated, because your income varies so dramatically and commission checks aren't always a guarantee. So when you do get a commission check, it's important to just take a portion of that and put it into your savings account. Now we'll talk about how much you actually need to set aside in those accounts. And it varies for each real estate agent. So there are strategies where you just set aside kind of what you think you might be paying overall in taxes. So let's say you thought, oh, I was in the 30% tax bracket, I'll just set 30% aside to be safe. That's a good strategy and it works, but I'm going to talk about a little bit more of an advanced strategy to allow you to keep more from your commission checks, pay the estimated amount towards those accounts to allow you to have more cash flow throughout the year to do things like invest, instead of potentially locking up more money than you should be at the time. So the first thing I'd recommend doing is to get familiar with the tax brackets. I think a lot of people overcomplicate tax brackets, and they sort of think of them like, oh, I ended up in the 32% tax bracket, which meant I paid 32% in my taxes. That's not necessarily the case. And the way I like to explain it is to think of the tax brackets like buckets. So if you have a 10% bucket, a 12% bucket, a 22% bucket, 24, 32, and let's just imagine that you're filing single, and this is tax brackets for the year 2024. So these are the previous year's tax brackets, but we're going to go ahead and kind of explain what it looks like when it comes to filling up each of these buckets to know how much you need to actually set aside when you get these commission checks. So in our example here, we have the first commission check that comes in, and it's $10,000. And like I said, for this example, we're going to assume that you're filing single, and these are the brackets for 2024. So don't use these brackets for 2025 and on. But let's say, for example, you get a $10,000 commission check. So your total income right here is $10,000. You would be filling up the 10% tax bucket, and I'm going to call them tax buckets from this point on, tax bucket almost all the way up. So obviously the cap is $11,600. Now let's say you get your second commission check. So the total income for the year is $20,000. Well, now you're going to obviously surpass that $11,600 bucket. So what ends up happening is $1,600 comes from that commission check and is going to get taxed in the 10% bucket. The $8,400 that's remaining, because now the 10% is filled up, the $8,400 that's remaining is going to be taxed in the 12% bucket. And it's going to fill up the 12% bucket almost halfway. Now you just made a $50,000 commission check. So now your total income for the year is $70,000. Well, if you've guessed right, we're going to fill up the 12% tax bucket above that $47,000 limit. So $22,850 will end up going into the 12% bucket to fill up the rest and be taxed at 12%. And then the remaining $27,150 will be taxed in the 22% bucket. So if you sort of understand what's going on here, whatever goes into each bucket gets taxed at that bucket's rate. So if it goes into the 10% bucket, you only need to set aside 10%. If it goes into the 12% bucket, you only need to set aside 12%. If your income goes up to $100,525, you're going to fill up the 22%, and then up to $191,950 is going to be taxed at 24%, and then $191,951 to $243,725 is going to be taxed at 32%. And this is sort of how they kind of come up with the effective tax rate. So, let's say you ended up in the 32% tax bracket. Does that mean that you were taxed fully at 32%? No. What it means is that your income filled up the 10, 12, 22, 24, and part of the 32% tax bracket. In fact, on average, you're going to have paid significantly less than 32% on your total taxes because you were mainly in those first four buckets. So your effective tax rate, or your average tax rate, would be about 20.9% instead of 32%. So if you did set aside 32%, you sort of, in a way, set aside 12% more than what you truly needed to. I want to mention that as a 1099, you owe the IRS quarterly estimated tax payments. These payments are estimated based on the income from the lesser of 90% of this year's tax liability or 100% of last year's, which turns into 110% if you make 150K or more. The strategy that I'm going over with the tax buckets is not a method to make accurate quarterly estimates. Instead, it should just be used as a way to get the most accurate number for your total tax bill by the end of the year. So if you have not saved enough to align with this 90 or 100% IRS rule, you may need to adjust your saving strategy. And if you have saved enough or more than what your quarterly estimate was, then you can keep enjoying the use of this tax bucket strategy. Working with a CPA or similar services can help you accurately estimate your quarterlies. Now, to take that $200,000 total income and put that to each of these strategies, where first strategy is you use the tax brackets, the second is you just set aside a flat 32% to be safe. So if you use the brackets, you set aside $41,800 for taxes, and you only ended up needing about $41,800 for taxes. If you set aside 32%, that means you set aside $64,000 for taxes, while you only needed $41,800 for taxes. So this is an additional $22,200 that you set aside that you could have used throughout the year on even treating yourself or saving money for investments or reinvesting in your business. And the problem is that if you're not doing this, you're sort of locking that money up and it's unavailable for you to use because you're expecting to pay that in taxes later. Now, does it have to be this complicated? No, you don't have to use the brackets. You can definitely set aside 32%. But for agents who want to maximize their cash flow throughout the year, maybe they're having cash flow problems, or maybe they just want to use that money to invest or dollar cost average to the market, or even put towards their own business or properties, using the brackets like buckets can help enhance your tax strategy and allow you to have more cash flow available to you throughout the year. Now, this is very complicated stuff, and it's best to work with a financial professional in order to get these things done. So what we've done at RockCrest is we've specialized working with real estate agents, helping them hopefully keep more from their commission checks and manage the cash flow from their commission checks, as well as set up retirement accounts and plan for goals like purchasing real estate investments. If you'd like to learn more, there's a link down in the description to our website where you can learn more about how we help our clients and our real estate agent clients. If you have any questions, leave them in the comments down below. And thank you for watching.